If you just left your job and you're afraid of a huge 401k tax bill, you're not alone. Millions of Americans are leaving their 401k money with their former employer because they're simply just afraid of messing things up. You told your job you no longer wanted to work there. You submitted all your documentations, you cleaned up your desk, and you took all your stuff with you, except your money. Today, I'm going to show you how to move your 401k money from your former job and move it over into your name while avoiding this huge 401k tax bill. My name is AB Ridgeway. I'm a certified private wealth advisor. I'm a tax professional admitted to practice in front of the IRS with my MBA in finance and the host of the Ridgeway Report. Decisions about your 401k can either protect your lifestyle or accidentally create taxes, stress, and ultimately regret. Today, I'm going to give you 3 practical tips that you can use to move your money away from your job, away from the government, and into your hands. The first thing you need to understand is that all 401ks are not created equal. Your first step when you retire is to reach out to your plan administrator. They are going to give you your benefits and how it relates to your specific job. You can't relate this to your neighbor's job. You can't Google this online. This is something strictly for your employer and your employer only. Even though 401ks are managed holistically and they're under the tax code subsection 401, the way they are dealt with on an individual basis is going to determine how you are going to actually move your funds and if you are even eligible. Sometimes there are some criteria for you to get matches, for you to qualify for bonuses, and we want to make sure we don't leave a single dollar on the table. Another thing we are going to identify is your age. How old are you when you are moving these funds? Are you younger than 55 years old? Are you over 59 and a half? Have you reached 70 plus? All those are going to determine what you can do with your 401k or what are some of the strategies we can come up with to help you move your assets into your name. So now that we've spoken to our plan administrator and now we're familiar with some of the rules surrounding the age in which we're making the withdrawal, we need to determine if there are any loans on your 401k. One of the benefits of having a 401k is that you can actually loan against it while you are employed. They could take the money out as a payroll deduction. You are going to check with your plan administrator to make sure there are no pending loans on your account. Sometimes we take these loans out when we're younger, 5, 6, 7 years ago, and we forget about them and they're still pending. We want to make sure this is clear because if we take this money out of the 401k, we potentially can have a tax implication for the remainder of the balance that needs to be paid before you roll over the money. If you have any question, once again, we can help you reach out to your plan administrator to see the terms and conditions of your 401k. But now that you have everything under control, you know the rules, you know your age, and you know that you qualify to go ahead and move over your 401k. The next step is to actually establish an account. Now, all accounts, once again, are not created equal. There's a difference between a taxable account and a tax deferred account. Many times when we're online and people say you should buy stocks, you should buy bonds, they are talking about a taxable account. Even though you can buy those in tax deferred account, typically when we're discussing capital gains, capital losses, they're talking about taxable accounts. Your 401k is not a taxable account, even though it can be taxed on withdrawals. It is considered a tax deferred account. It doesn't mean tax exempt. It doesn't mean tax free. It means tax deferred, meaning the taxes will be paid at a later date. You also need to understand what type of money are in these accounts. Nowadays, companies are often what they call a Roth 401k. This is a little bit different than the traditional 401k, which deals with pre-tax money. This deals with post-tax money. Then we need to determine what type of funds are in that 401k account. Are they going to be Roth funds? Are they going to be traditional 401k funds? Now, what we don't want to do when we're establishing this account, and this is one of the biggest mistakes that I see people make, is that they like to commingle funds. They think, well, if I'm going to roll my assets into an IRA, into my own name, my wife has an IRA, can I just give it to her? No. Individual retirement account. So if your spouse says, why don't you just roll the money into my account? You can't do that. One social, one account. Individual retirement account, not married retirement account. This leads me into my third point, actually moving the money. This is where a majority of people make their huge mistake. They know they can move their 401k. They already have an individual retirement account established. If you need help establishing an account or don't know where to start, you can reach out to us. We can help guide you in the right direction. There are several ways that you can actually withdraw the money from your 401k account. Some of them have greater tax implications than others. Some don't have any at all. And I'm going to teach you the one that I know that you want to hear. How do we avoid that big 401k retirement tax bill when we retire? There are three types of withdrawals. One is a direct, one is an indirect, and the other one is a cash out. What a cash out is where you liquidate all your money. You say, I'm done. Give me my money. I want to take the check and I want to deposit it into my savings account and I am done with it. That is one of the biggest mistakes retirees make, because when you cash out your 401k, that is the time you are going to pay taxes. So if you have a $1 million, $2 million retirement, you cash it out, you are automatically in the 37th percentile. If you're under 59 and a half, you're going to suffer a 10% penalty and you are going to lose 47% of your retirement on one decision. Now, what's the alternative? The alternative is that you can either do a direct or an indirect rollover. That means you take your 401k and you put it into an individual retirement account. The first option being an indirect rollover. The way it works is that your 401k plan administrator will liquidate your 401k into cash, send you a check and say, here's your 401k. At this point, the clock starts ticking. You have 60 days to do two things. Either take the money and put it into an IRA yourself or pay the taxes as a withdrawal. Some people use this option if they need $5,000, $10,000. They'll take a portion of it and put the remainder in an individual retirement account and pay the taxes on the portion that they keep. But there is some mistakes people make. They may take out $10,000, but they missed the deadline to open an account and put it into a new account before the 60 days are over, and that disqualifies them and they get hit with a huge tax bill. So before you even think about taking an indirect rollover, make sure an account is already established and you do it in enough time. Third option is the direct rollover. This is where you don't have to worry about mistakes and time. You don't even have to get into the middle of it. This is when your plan administrator sends a check addressed to the custodian, meaning the company that you established the account. That way, the government doesn't feel that you're holding the money. They send you a check for the benefit of you. You take the check, you deposit it. You don't have to worry about the time frame because the check is technically not made out to you. You're not going to take the check and put it into your savings account. You're not going to take the check and put it into your checking account. You're going to wait, take that check and put it into the established individual retirement account. That is the way that you do not trigger a taxable event. It is what we call a custodian to custodian transfer. Before you run off to your administrator to get everything rolling, there's another thing you need to know before we put it all together. You have to reinvest the money. This is one of the biggest mistakes I see retirees make. They say, Mr. Ridgeway, I rolled over my money from my 401k. I'm not making anything. It's the most horrible decision I've ever made in my life. No one should have took it out of the 401k. I was doubling and tripling my money in my 401k retirement, and here, nothing. Then when I look at the statement, Mr. or Mrs. Client, it seems that you did not reinvest the money that you received. When you leave your 401k, they are not giving you the assets. They are liquidating the assets, putting it into cash. So when you reinvest it, only thing that's in that account is cash. And it's going to do the same thing it does in the savings account. Not do anything until you reinvest it into something new. That's why it's very important to have a financial advisor who can guide you in making those investment decisions. Yes, an individual retirement account's in your name, but you also have more responsibility to control your future. Moving your 401k from your old employer to your individual retirement account is a huge decision and you don't want to make any mistakes. Here's the takeaway. 401ks look very simple on paper, but retirement life is very complicated. There are fees and taxes associated with many of the transactions. You don't want to work 20, 40, 60 years. And when you get to the finish line, you drop the ball because you made a mistake. The goal is not perfection. It's to be intentional. The goal is not perfection. The goal is to avoid huge tax bills. The goal is not perfection. The goal is to establish a plan that you can stick with. So if you're still afraid to make that leap of faith and roll your 401k into your name, reach out to us, schedule a consultation. I'll complete a 401k retirement review for you, go over some of your potential tax implications. All you need to bring is your plan administrator booklet so we can figure out where you are. And if this is you, click the link in the description below, schedule a consultation with me. We'll review your options and we can move forward so you don't have to be afraid to use your own money. Well, that's it for me. My name is AB Ridgeway, and this has been another Ridgeway Report.